Today, we are jumping headfirst into a topic that affects literally everyone, but is often understood, well, kind of superficially. We're talking about money.
But not just the numbers, the dollars and cents. We're looking at the psychology of money. The material we're digging into today is based on some really powerful excerpts from The Psychology of Money.
Right, and the core idea is fascinating. It argues that doing well with money isn't really about how smart you are or, having some complex financial degree.
Nope. It's about behavior, how you act with money.
Behavior, it sounds almost too easy, like just behave well.
Yeah.
But the stories and the research in this material, they show it's this deeply overlooked truth with, frankly, huge consequences.
And the source material doesn't mess around. It hits you with these incredible contrasts right at the start. Like this story of a tech executive. Super brilliant guy, apparently.
Yeah, patents for Wi-Fi components, built and sold companies, made a ton of money.
The kind of person you'd expect to be great with finance, right?
Yeah.
But his behavior around money, the source calls it insecure, childishly stupid.
We're talking carrying huge wads of cash, bragging constantly, and then it gets weirder. Like throwing $1,000 gold coins into the ocean. Just because.
Gold coins.
Yeah. And damaging hotel property, throwing cash at a manager just to be rude.
Wow. So just completely reckless behavior.
Totally erratic. And despite being a genius at making money, this behavior led him to go completely broke.
Bankrupt. After all that success, it's hard to fathom.
Now contrast that story with Ronald Read.
Ronald Read. Okay, so the source mentions his Wikipedia entry sums him up perfectly. American philanthropist, investor, janitor, and gas station attendant.
Janitor and gas station attendant. Doesn't exactly scream finance guru.
Not at all. Lived super humbly in Vermont, worked those jobs for decades. Small house, chopped firewood for fun.
You never guess, looking at his life.
That when he died at 92, he'd quietly amassed a fortune of over $8 million.
$8 million.
As a janitor.
Yep, left it to family and local charities. People were floored. No lottery win, no inheritance.
But how?
It was almost insultingly simple. He saved what little he could, invested it in basic blue chip stocks,
and
waited for decades. Just waited.
Wow. Patience personified. Okay, so then there's the third person mentioned right at the start, Richard Fuscone.
Ah, yes, Fuscone. He was basically the opposite of Ronald Read, on paper at least. Harvard-educated, top exec at Merrill Lynch, retired young, seen as a model of financial success.
Right, the finance titan type.
Yeah.
But then he gets this massive 18,000 square foot mansion, 11 bathrooms, multiple pools. The upkeep costs alone must have been insane.
Predictably, when the 2008 crisis hit. All that debt, illiquid assets.
Bankruptcy. Mansion foreclosed, sold for pennies on the dollar.
So the tech genius and the Harvard finance expert both broke, driven by, well, terrible financial behavior.
While the humble janitor becomes a multimillionaire philanthropist through simple, disciplined behavior.
The contrast couldn't be starker, and the source makes the point. Finance isn't like brain surgery or rocket science where the untrained amateur just can't compete.
Exactly. The janitor can absolutely outperform the Harvard MBA in finance because it's less about what you know and more about how you behave.
It's not your IQ, it's not your fancy degree, it's those softer skills, patience, discipline, controlling your emotions. It really is the psychology of money.
Which perfectly sets up the first big theme from the material, why psychology matters so much more than the math.
Yeah, let's get into that.
The core idea, right off the bat, is that behavior is just incredibly hard to teach, especially maybe to really smart people. But it's the critical factor for financial success.
Think about other fields, right? Like medicine or physics. They operate on hard science, fixed rules.
Gravity doesn't care about your feelings, like you said. But money. Money is driven by people, by emotions, biases, unique histories. It's messy.
So when you see someone making a decision that looks totally bonkers financially, like taking on crushing debt or selling everything at the absolute bottom of a market crash.
You can't understand it just by looking at interest rates or expected returns on a spreadsheet. The math doesn't explain the why.
You need that different lens.
Yeah.
Psychology, history. You need to think about greed, fear, insecurity, optimism. Those are the real drivers.
The material mentions this book is an expansion of an earlier report that identified 20 key behavioral biases or features. So it's like 20 deep dives into different facets of this core idea.
Chapters you can read on their own, but they all point back to behavior is king.
Which leads us straight into the first big insight the source calls. No one's crazy.
Okay, explain that. It doesn't mean bad decisions aren't bad, right?
Right. It means that everyone's personal, unique experiences with money fundamentally shape how they see the world financially. Their beliefs, their goals, what they expect to happen, what looks utterly crazy to you might make perfect sense to someone else based on their life story.
Like growing up poor versus rich, your whole attitude towards risk, towards opportunity, it's going to be completely different.
Or imagine living through hyperinflation where money becomes worthless overnight versus only knowing stable prices. That shapes how you view savings, debt, everything.
The Great Depression versus the dot-com boom. Polar opposite experiences leading to polar opposite core beliefs about markets.
The source points out Australians went like 30 years without a recession. No American alive has experienced that kind of stability. That creates a fundamentally different baseline perspective on economic risk.
And here's the statistic that blew my mind. Your personal experiences, which are maybe, what, 0.000000001% of all world events,
Yeah. A tiny slice.
they make up something like 80% of how you think the world actually works.
Isn't that wild? So your limited experience becomes your overwhelming reality filter. Two equally smart people can look at the exact same economic data.
And come to totally different conclusions. And both feel completely rational based on their own internal model.
It's not about intelligence, it's about their lived history. The JFK anecdote is perfect here. He admitted he didn't really experience the Great Depression because his family was rich and actually did okay.
He learned about it by reading books later.
And people felt, maybe rightly, that he couldn't truly grasp the nation's economic trauma without having lived it.
Because reading about fear isn't the same as feeling it.
Exactly. You can study a market crash, analyze the data points, but that's worlds away from watching your life savings vanish and genuinely fearing for your future. One is intellectual, the other is visceral. It scars you differently.
Research actually confirms this. Economists studied decades of data.
Malmendier and Nagel, yeah.
Right. And they found people's investment choices throughout their lives are heavily influenced by the market conditions they experienced in their early adulthood.
So if you came of age during high inflation, you might distrust bonds forever. If you saw stocks booming in your 20s, you're more likely to favor stocks. It's tied to the historical accident of your birth year, not just your smarts.
Bill Gross, the famous bond investor, basically admitted his career was lucky because he rode a decades-long wave of falling interest rates. Bonds felt like winners to him.
But to someone whose formative years were the high inflation 70s, bonds probably looked like guaranteed losers. Same asset, totally different perceptions based on timing.
The source shows charts comparing market returns and inflation by birth year. It's staggering how different the normal experience was for people born just 10 or 20 years apart.
Someone hitting adulthood in 1970 saw huge real stock growth. Someone starting in 1950 saw basically nothing for years.
Or inflation, huge in the 60s and 70s, almost non-existent for those coming of age in the 90s or later.
You just can't expect these groups to react the same way to financial news, trust the same advice, or agree on what's likely to happen. They were formed in fundamentally different financial worlds.
There was that really striking anecdote from the New York Times comment section about the factory worker in China.
Oh, yeah, that was intense. Americans saw a story about poor conditions and thought, sweatshop exploitation. But a comment came in from someone whose aunt worked there,
saying the aunt felt the factory job was a massive step up from her previous life as a prostitute.
Gut-wrenching. But it just shows how radically different lived experiences can make you see the exact same situation in opposite ways. Terrible from one angle, an improvement from another.
So every financial decision, even if it looks objectively bad or based on misinformation,
it makes sense to the person in that moment. Given their unique history, their mental model, their blind spots, they're operating within their own narrative.
Like buying lottery tickets. The odds are terrible, especially for low-income folks.
Looks completely irrational from a purely financial standpoint.
But if you're living hand-to-mouth with no clear path to saving or earning more, that lottery ticket isn't just a bad bet, it's hope. It's the only tangible way to dream of a dramatically better life.
You're essentially paying for the dream, however fleeting, and you don't have to agree with the choice to understand the very human impulse behind it.
So many decisions are this messy mix, right? Personal history, ego, keeping up with the Joneses, marketing, strange incentives.
And compounded by the fact that so many financial tools are relatively new, 401ks, index funds, even widespread credit card debt, These haven't been around for generations.
We're all kind of learning as we go, figuring it out.
Making decisions based on our limited, unique, sometimes crazy experiences. But nobody is truly crazy. They're just acting based on the world they know.
Which brings us to those forces we don't control: luck and risk.
Yeah, the source calls them siblings. Basically, the reality that outcomes aren't just about your effort. Chance plays a huge role.
Scott Galloway's quote fits perfectly. Nothing is as good or as bad as it seems.
Right. Success usually involves some good luck. Failure often involves some bad luck. It's rarely 100% earned or 100% your fault.
The Bill Gates story comes up again, focusing on the sheer luck involved. Attending one of the very few high schools in the entire world in 1968 that had a computer students could actually use.
Lakeside School in Seattle, 1 in a million chance, maybe more. His skill is undeniable. But that access, that specific time, pure luck.
And the heartbreaking flip side, his friend, Kent Evans. Equally smart, equally driven, exploring that computer with Gates.
They were planning their futures together.
But Kent died in a mountaineering accident before graduation. Another incredibly rare 1 in a million type of event. Just risk. Same magnitude of randomness, opposite outcome.
Luck and risk are tough to grasp, tough to measure. Life's messy. Things happen outside your control that can matter way more than your deliberate actions.
Robert Shiller, the Nobel economist, said the one thing he wished he could quantify is the exact role of luck.
Because it's hard. And it feels kind of rude, right? To tell someone they just got lucky. Or even to attribute your own success purely to luck. Feels like you're diminishing your effort.
There's that research showing brothers' incomes are more similar than their height or weight, suggesting outside factors matter a lot.
But wealthy brothers often resist that idea. They prefer the narrative of individual achievement. It's hard to internalize luck's role, especially in your own success.
And failure. We love blaming bad decisions. Should have known better.
But how much was truly a bad call versus just being on the wrong side of probability? Risk just showing up. Hard to untangle. We use simple stories for others' failures, complex ones for our own.
The real danger, the source says, is learning only from the extremes, studying the mega successes or the epic failures.
Because those extreme outcomes are usually heavily influenced by extreme luck or extreme risk. They're often the least useful lessons for the average person.
Better to look at broad patterns. What works, what fails, for typical people and typical situations. That's more applicable.
Think about figures like Vanderbilt or Rockefeller. Brilliant, yes. Ruthless, yes. Broke laws, sometimes. How much was skill, luck, risk, timing? Almost impossible to say, especially looking back.
Even Benjamin Graham, Buffett's mentor, had his biggest win with Geico, an investment that broke his own diversification rules. Was it a stroke of genius or, as he wondered, just one lucky break?
So the point isn't that effort doesn't matter. It's about having humility. Be careful who you idolize or condemn. Recognize the role of chance. Not all success is purely earned. Not all poverty is purely deserved. And apply that same lens to yourself.
Yeah, success can make you forget risk. Failure can make you too scared to try. That balance is key. Nothing's as good or bad as it seems. Forgive yourself when risk bites you. The key is surviving those hits.
Which leads perfectly into the next big danger zone. Never enough.
Ah, the moving goalpost problem. The source uses that great story from John Bogle, Vanguard's founder.
Right, at a billionaire's party. Kurt Vonnegut points out to Joseph Heller that the host made more money in one day than Heller ever made from Catch-22.
And Heller's classic reply, yes, but I have something he will never have.
Enough. Just perfect.
That concept of enough is so powerful. The material uses some really stark examples of what happens when you don't have it internally.
Rajat Gupta rose from nothing to CEO of McKinsey, worth $100 million, had everything.
But the source suggests this billionaire envy got to him. He saw people with even more.
And he risked everything, his reputation, his freedom for insider trading, just to get more. He didn't have enough.
Bernie Madoff, already incredibly wealthy, still ran a massive Ponzi scheme. Like, just more.
These are extreme criminal cases. But the non-criminal version happens all the time. Think long-term capital management. Brilliant guys, already rich, took insane risks to get even richer.
Buffett's quote on them is spot on. To make money they didn't have and didn't need, they risked what they did have and did need. And that's foolish. Simple rule. Don't risk what's essential for something that isn't.
Most of us aren't aiming for billions, but many listening will reach a point where all reasonable needs, and even many wants, are covered. If that's you, the source has some crucial reminders.
First, the hardest financial skill is stopping the goalposts from moving. As soon as we reach one level, we start eyeing the next. It's human nature, but dangerous.
And it's fueled by number two, social comparison, keeping up with the Joneses. It's a battle you absolutely cannot win.
The example of the rookie baseball player feeling poor next to the superstar, who feels poor next to the team owner, who feels poor next to Jeff Bezos. It just keeps going up.
There's always someone richer. The only way to win that game is to refuse to play. Like the Vegas dealer said, exit as soon as you enter. Just opt out of comparing your wealth.
Third point, enough doesn't mean deprivation. It means realizing that an endless appetite for more eventually leads to regret, like eating until you're sick.
People do the financial equivalent all the time, chasing every last dollar, taking reckless risk, burning themselves out. That inability to say no to potential gains eventually catches up.
And fourth, some things are just never worth risking, no matter the potential payout. Your reputation, your freedom, your family and friends, your basic happiness and independence.
Gupta didn't just lose money. He lost those things, priceless things. Knowing when you have enough is what protects them. It gives you the power to say no to things that threaten what truly matters.
And the source suggests there's a powerful, simple tool for building that enough without risking those crucial things.
Which brings us to the magic of confounding compounding.
Yes, the secret sauce. The source uses a brilliant analogy from outside finance. Ice ages.
Yeah, the idea wasn't just super cold winters. The key, refined by Köppen, was moderately cool summers.
Summers that weren't warm enough to melt all of the previous winter's snow. Just a little bit survived.
And that tiny bit made it easier for more snow to stick the next year, which reflected more sunlight, making it cooler still. That tiny, persistent change snow lasting compounded over centuries.
Resulting in mile-thick ice sheets covering continents, all from a small, consistent starting point. It's not necessarily the amount of snow, but the fact that snow, however little, lasts.
That's compounding in finance. Huge results from small beginnings or small, consistent additions, if given enough time. It's deeply counterintuitive. We underestimate its power.
Warren Buffett. Again, the perfect example. We focus on his investing skill, which is legendary. But the biggest, simplest factor, longevity. He's been compounding since he was basically a kid.
His net worth is astronomical now. But get this, almost all of it, like 99.9% of it, was earned after his 50th birthday. Even more after he qualified for Social Security.
That's insane. So his skill is investing, but his secret weapon is time.
The thought experiment drives it home. If he started later or retired earlier, even with his amazing returns, his fortune would be a tiny fraction of what it is. Time is the incredible multiplier.
Compare him to Jim Simons at Renaissance. Simons gets way higher annual returns, like 66% versus Buffett's 22%.
But Buffett is still vastly richer. Why?
Simons didn't start compounding that kind of money until he was 50. He's had less than half the time. The sheer power of decades of compounding just dwarfs even those higher returns over a shorter period.
Exponential growth just messes with our linear brains. Adding 8 repeatedly is easy to grasp. Multiplying by 8 repeatedly, the numbers get crazy fast.
Like hard drive storage. Tiny increases for decades, then suddenly, boom, exponential growth. Even Bill Gates couldn't quite grasp it early on.
Because compounding isn't intuitive, we tend to chase other things, like the highest possible short-term returns. We miss the quiet magic that happens over decades. So good investing isn't necessarily about hitting home runs every year. It's about getting pretty good returns consistently that you can stick with for the longest possible time. That's where compounding truly takes off. Just shut up and wait.
Which connects perfectly to the next insight, the difference between getting wealthy versus staying wealthy.
Yeah, the source says there are a million ways to get rich, but really only one way to stay rich. A combination of frugality and paranoia.
Jesse Livermore, the trading genius from the 1929 crash, made billions shorting the market. Abraham Germansky, ruined by the same crash. Both were amazing at getting wealthy.
But Livermore couldn't stay wealthy. Got arrogant, took bigger risks, used debt, lost it all, ended tragically. His problem wasn't making money, it was keeping it.
Financial success, the source argues, boils down to one word: survival. Capitalism is tough. Companies fail, fortunes vanish. Staying in the game is paramount.
Getting money often requires optimism, risk-taking. Keeping money requires the opposite. Humility, fear, knowing it can disappear, frugality, accepting luck's role.
Michael Moritz from Sequoia Capital said their secret to decades of success was being afraid of going out of business, assuming tomorrow will be different. Only the paranoid survive.
And survival is crucial for compounding, right? You need to stay invested through the inevitable downturns and crises to let that long-term magic work.
Think about Buffett again. What didn't he do? He didn't get buried in debt. He didn't panic sell. He didn't ruin his reputation. He didn't burn out. He survived for over 70 years. That survival enabled the compounding.
Story of Rick Guerin, the third partner with Buffett and Munger early on. Just as smart, apparently, but he was in a hurry.
Used margin loans, got wiped out in the 73-74 crash, forced to sell his Berkshire stock to Buffett cheap. Warren and Charlie survived. Rick didn't.
Nassim Taleb nails it. Having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs.
So what does this survival mindset look like in practice?
First, prioritize being financially unbreakable over chasing the absolute highest returns. Being unbreakable lets you stay in the game long enough for compounding to work its magic, which ultimately produces the biggest returns.
Holding cash might feel like you're losing out during a boom.
Right. Feels conservative, maybe even dumb. But if that cash prevents a forced sale during a crash, its real return, the return of avoiding ruin, is potentially massive. Good returns sustained beat great returns interrupted.
Second, plan, but always plan on the plan not going according to plan. Think about the last 2 decades. 9/11, housing bust, financial crisis, pandemic. Nobody predicted all that. A good plan has buffers.
Yeah, fragility comes from needing everything to go just right. Room for error, a flexible budget, diverse income streams maybe. A loose timeline lets you absorb shocks. It increases your odds of success simply by increasing your odds of survival.
Third, cultivate that barbelled personality with money. Be optimistic. Long-term progress happens, markets generally trend up, but be paranoid about short-term threats that could knock you out of the game.
Growth and destruction happen together, like the U.S. economy growing despite wars and recessions. Short-term paranoia ensures you're still standing to benefit from the long-term optimism.
Jesse Livermore let success go to his head and ignored risk. Failure can paralyze you. You need that balance. Survive the downturns. Forgive yourself for mistakes influenced by risk. Stay humble.
And speaking of unpredictable results, let's talk tails. You win.
This is the idea that a very small number of things drive most of the outcomes.
Right.
Like Brad Pitt saying, some movies work, some don't, just move on.
Exactly. The art dealer Heinsberg Gruen is the example. Most art he bought was worthless, but a few outliers, like his Picassos, made his entire fortune. He was wrong most of the time, but still won big because of the tails.
Long tails. That's the concept in business and investing. A few big wins pay for all the losses and generate all the profit. It's counterintuitive. Makes us underestimate how normal failure is.
Walt Disney's story fits here too. Hundreds of cartoons, many lost money. But one massive tail event, Snow White, changed everything. Paid off debts, funded growth, made him a legend.
We focus on the big successes, the blockbusters, the Amazons, the hunter-bagger stocks. They're visible results of tail events. But we forget how rare they are and how much failure lies beneath them.
Venture capital data is brutal. Like 65% of investments lose money. Almost all the returns come from a tiny fraction, the huge winners.
And it's true for public stocks too. The source cites Russell 3000 data. 40% of companies basically cratered and never recovered. Nearly all the index's long-term gain came from just 7% of the top performers.
The winners just massively outweigh the losers. This happens inside companies too. Amazon's growth driven by Prime and AWS, outliers from hundreds of experiments.
And it applies to our behavior as investors. Napoleon's definition of genius, doing the average thing when everyone else is going crazy. Your long-term success is often determined by how you behave during those few crucial moments of panic or euphoria.
That example of investing $1 a month for over a century, the person who just stayed invested, even through crashes, ended up far wealthier than the person who tried to time things and missed just a few key recovery periods. Success came from behaving correctly during the few crazy tail months.
Acting right during 2008-09 probably had more impact than anything else you did for years before or after.
Once you accept that tails drive results, you realize failure is normal. Most stock picks won't work out. Most business ideas fail. Success comes from being right enough on the few things that really move the needle.
Peter Lynch said, being right 6 out of 10 times makes you terrific. Even the best have tons of failed ideas. Bezos had the Fire phone. They accept failure as part of finding the outliers.
The tricky part is we only see the successes. We see Buffett's winners, not all the duds.
Yeah.
So when our ideas fail, it feels personal, like we're uniquely bad. But the masters are wrong plenty. They just make a fortune when they're right. It's about the asymmetry. How much you make when right versus lose when wrong.
Okay, shifting gears slightly. What does the source say is money's highest dividend? Not returns, but freedom.
Yeah, the ultimate form of wealth isn't the Lamborghini. It's waking up and knowing I can do whatever I want today. Control over your time.
People chase wealth hoping it brings happiness. Happiness is complicated, sure, but one common denominator seems to be control over your own life.
Research by Angus Campbell backs this up. Feeling in control, doing what you want, when, where, with whom, for how long is a better predictor of well-being than just your salary or house size.
So money's greatest value isn't buying stuff, it's buying control over your time. Independence. Autonomy.
The story about the investment banking internship illustrates this. Amazing pay, prestige, but the brutal, uncontrollable hours made it miserable. Doing something you love on someone else's punishing schedule can feel just as bad as doing something you hate. We hate feeling controlled.
Derek Sivers' story, too. Saved just $12K, quit his job at 22 to be a musician. The freedom he bought then was more life-changing than the millions he made later.
And the source points out the U.S. paradox. Richest country ever, but people aren't necessarily happier than in the 1950s when they had less. Stress and worry levels are high.
Why? Maybe we used the wealth to buy bigger houses and more stuff, but we traded away control over our time in the process. Longer commutes, more demanding jobs.
The nature of work has changed, too. Knowledge work means the factory our brain is always with us. It feels harder to truly switch off compared to physical labor jobs of the past.
We feel on 2047. Less control over our time, even with more wealth. It helps explain why more money hasn't automatically equaled more happiness.
Recognizing this is key. Those interviews with elderly folks, they didn't value the long hours or fancy stuff. They valued relationships, purpose, time with family. Kids want your presence more than your presence, basically.
Controlling your time. That's the highest dividend money pays.
Now, let's talk about maybe the lowest dividend. The man in the car paradox.
This comes from the author's experience as a valet, right? Parking incredible sports cars.
Yeah, he'd see a Ferrari pull up and think, wow, that car means the driver is cool, admired, successful. If I had that car, people would think I'm cool.
But the irony...
He almost never actually looked at the driver. He was just projecting himself into the car, admiring the object, not the person.
And that's the paradox. We buy expensive things hoping others will admire us. But often, people just admire the thing and use it as a benchmark for their own desire for admiration. They bypass you completely.
You want respect and admiration. You think the fancy stuff delivers it, but it rarely does, especially from people you actually care about.
Did the drivers of those Ferraris realize the valet didn't care about them, only the car? Did they buy the car for admiration they weren't actually getting?
Probably not. Applies to big houses, jewelry, clothes, too. Using money to buy visible status symbols often brings far less respect than you imagine.
If respect is the goal, you get it through humility, kindness, empathy, not horsepower.
Which ties perfectly into the next insight. Wealth is what you don't see.
This feels counterintuitive, but makes so much sense. Wealth is invisible.
Think about that valet story again. The guy Roger in the Porsche that got repossessed, he looked rich driving that car, but he was broke. Appearances are deceiving.
We judge by what's visible because we can't see bank balances or brokerage statements. We see the car, the house, the Instagram posts, and society encourages faking it.
But true wealth, the source argues, is the financial assets you haven't spent yet. It's the nice cars not purchased, the diamonds not bought. It's income saved, not consumed.
The Rihanna story is hilarious but pointed. Her advisor supposedly had to explain that if you spend money on things, you end up with the things, not the money.
Seems obvious, but apparently not. People confuse wanting to spend $1 million with wanting to be a millionaire. They're opposites. Spending makes you less wealthy, not more.
Bill Mann's quote, "Fastest way to feel rich is spend lots. Way to be rich is spend money you have, not money you don't." The source refines it. The only way to be wealthy is to not spend the money you have. That's literally the definition of wealth, unspent assets.
Rich is often current income, visible spending. Wealth is hidden, unspent income providing options, flexibility, future growth.
The problem is, rich role models are easy to find. They show off. Wealthy role models are hard to find because their success is invisible. We see their spending, not their savings.
We admire the person buying the fancy car, not the person who could buy it but chooses to save instead. We don't see the restraint required for wealth, so it's hard to learn or imitate. Ronald Reed, the janitor, was nobody's role model while alive because his wealth was hidden.
The world is full of people who look modest but are wealthy, and people who look rich but are living on the edge. Be careful who you emulate and what you judge by.
Which brings us to the absolute foundation, according to the source, just plain save money.
Yeah, the author basically says, let me try to convince you to save, acknowledging some people think they can't or don't need to.
First big idea here. Building wealth is less about your income or investment returns and much more about your savings rate.
The oil efficiency analogy works well. We didn't avoid running out of oil just by finding more. We got way more efficient at using it.
Efficiency, like saving, is controllable and always works. Finding more oil, like getting huge investment returns, is uncertain. Building wealth through frugality gives you more control over your destiny.
Wealth is just the gap between your ego and your income, accumulated over time. Savings rate is the most powerful lever you control. You can build wealth on a modest income with a high savings rate. You can't build wealth on a high income with a zero savings rate. Simple as that.
Second idea, wealth's value is relative to what you need. If you need less to be happy, your savings go further. Being content with less is like getting a raise, but easier and more controllable.
Spending beyond basics is often just ego trying to signal status.
So a powerful way to save more isn't just earning more, it's increasing your humility, caring less about what others think of your car or house. Savings is that gap between ego and income.
Third idea, save just for saving's sake. You don't always need a specific goal like a house or retirement.
Life is full of surprises. Saving is your buffer against the unexpected curveballs that inevitably come at the worst times.
And the intangible benefits are huge, connecting back to freedom. Savings buys you options, flexibility, control over time, the ability to wait for good opportunities. Every bit of savings is like taking a point in the future that would have been owned by someone else and giving it back to yourself.
What's the ROI on cash that lets you sleep at night or quit a bad job? Incalculable, but immense, often overlooked because it doesn't fit neatly on a spreadsheet.
Flexibility yields returns. Cash lets you seize opportunities when others are forced sellers or desperate. It lets you wait, learn, adapt. Control over time is a superpower.
So, yes, save money. More people can, more people should. It's the controllable path.
Okay, so when making decisions with that saved money, the advice is reasonable, rational.
Right. You're a person, not a spreadsheet. Don't aim for cold mathematical perfection. Aim to be reasonable. Reasonable is realistic, sustainable, and helps you stick with things long term, which is crucial.
The crazy syphilis malaria treatment story illustrates this. Inducing a high fever with malaria was technically rational to kill syphilis.
But completely unreasonable for the patient suffering through the fever. People want help to stop hurting.
Finance academics chase optimal strategies on paper. Real people want strategies that let them sleep at night. Reasonable over rational.
Harry Markowitz, the portfolio theory Nobel winner, invested his own money 50-50 stocks bonds, not because his model said so, but to minimize future regret. She worried about losses and missing out. Not strictly rational, but reasonable for him.
Some technically rational ideas are just nuts in reality. Like that study suggesting young people use 2-to-1 leverage on stocks.
Mathematically, it might boost long-term expected returns, even accounting for being wiped out occasionally, but who could emotionally handle losing everything and just starting over with the same strategy? It's completely unreasonable.
The source even suggests maybe it's okay to love your investments if that emotional connection helps you stick with them through thick and thin. That endurance becomes a quantifiable advantage.
Because the odds of winning in the market improve dramatically over time. Staying in the game is paramount. If passion for a company helps you hold on during a crash, that's valuable.
Other examples where reasonable trumps rational. Home bias in investing. Maybe day trading tiny amounts to scratch an itch. Making forecasts, but not acting rashly on them.
Jack Bogle investing in his son's high-fee fund. Not consistent, but reasonable for family reasons. Life isn't always consistent.
Exactly. Aim for reasonable decisions that fit your life, your emotions, your context. Sleeping well is a perfectly valid financial goal.
And speaking of context, we often look to the past, but the source warns, surprise, history is a misleading guide.
Because things that have never happened before happen all the time.
Right. Yep. And we ironically use history, the study of past surprises, as if it's a perfect roadmap for the future in finance. But finance isn't physics. It's driven by human behavior, which changes. Electrons don't have feelings or change their minds based on the news. People do.
Treating history as prophecy is dangerous, especially when the most important events, depressions, world wars, tech bubbles, pandemics, are often massive outliers with no real precedent.
These outliers move the needle most and have cascading effects, like 9/11 leading to rate cuts, fueling the housing bubble, causing the financial crisis, one surprise leading to another.
Forecasting based only on past extremes assumes unprecedented things won't happen again. like building the dam only for the worst flood recorded, not imagining a worse one. Failure of imagination.
Kahneman's point, the lesson from surprises isn't avoiding that specific mistake again. It's realizing the world is fundamentally unpredictable. Surprises will happen.
The other danger is ignoring structural changes. 401k, index funds, the internet, modern VC. The financial world is vastly different than it was 50, even 25 years ago. Old patterns might not apply.
Benjamin Graham constantly updated his formulas because the market changed. His general wisdom endures, but the specifics became obsolete quickly.
So learn general lessons from history, greed, fear, cycles, but be wary of applying specific past trends directly to the future. It's different this time, is sometimes true.
If history is an imperfect guide, how do we navigate an uncertain future? By building in room for error.
Margin of safety, like the blackjack card counter needing enough cash to ride out bad luck streaks, even with an edge.
You're never so right you can bet the farm. You need buffer. Plan on the plan failing somehow. It's the only way to deal with odds, not certainties.
Margin of safety isn't just being timid. It actually increases your odds of success by ensuring you survive long enough for good strategies or luck to pay off.
Gates keeping cash at Microsoft, Buffett prioritizing sleep over leverage. That's valuing room for error.
Where do we need it? Volatility. Can you mentally handle a 30% drop? Spreadsheets ignore the emotional pain.
Retirement planning. Using historical average returns is a starting point, but what if the future is worse? What if you retire into a crash? You need a buffer, lower return assumptions, higher savings rate. Aim low to increase your odds of happiness.
And avoid the Russian roulette should statistically work trap.
Yeah.
Favorable odds don't matter if the downside is ruin. Leverage often turns manageable risks into ruinous ones.
You can like risk, but you must hate ruin. A barbelled approach makes sense. Safe with the core, take calculated risks with a smaller portion, ensures survival.
Room for error also protects against the completely unknown risks. The mice-chewing tank wires scenarios, things you literally cannot imagine.
Redundancy. Planes have backup systems. Your finances need backups too. Avoid single points of failure. Everything that can break eventually will.
Room for error gives you endurance, flexibility, protects against unknowns, and allows compounding to work. It's essential.
Now, a tricky one about ourselves. You'll change.
We're bad at predicting our future selves, right?
Mm-hmm.
The friend who fought to become a doctor then hated it.
Yeah. We imagine the goal, not the grind, or how our values might shift. People change careers, life priorities. The person you are at 25 wants different things than the person you'll be at 45 or 65.
That end of history illusion. We think we've finally become us. Underestimating future changes happens our whole lives.
This wreaks havoc on rigid long-term financial plans. Compounding needs consistency, but we change, interrupting the plan.
Life might be a series of 20-year blocks with different priorities, not one smooth trajectory.
So avoid extreme financial plans. Don't assume you'll live on pennies or work forever. Those extremes often lead to regret later when you've changed.
And accept that you will change your mind. Embrace it. Don't cling to past decisions because of sunk costs.
Kahneman, I have no sunk costs. Letting go of past goals that no longer fit frees your future self. The sooner you abandon sunk costs, the sooner you compound on a path relevant now.
Which connects to the idea that success isn't free. Nothing's free.
Everything has a price. The trick is identifying it and being willing to pay. Often, the price is invisible until it's too late.
Like the GE CEO finding the job way harder than it looked from outside. The price was hidden complexity.
Investing looks easy in hindsight, just buy and hold. But the price is enduring volatility, fear, doubt, regret. It's not free money.
Trying to avoid the price, market timing, usually makes you pay double in missed gains and bad decisions.
So frame volatility as a fee, not a fine. It's the price of admission for market returns, like a Disneyland ticket. Pay the fee willingly.
Identify the price of success in finance and commit to paying it. Don't try to get returns for free.
And a major source of error comes from forgetting. You and me, different games.
Taking cues from people playing a totally different financial game than you are. Huge mistake.
Your time horizon dictates what's smart. A day trader and a retirement saver look at the same stock price completely differently. One sees momentum, the other sees long-term value, or lack thereof.
Bubbles often happen when short-term traders pile in, chasing momentum, ignoring long-term fundamentals that matter to others. Different games colliding.
The danger is you don't know why others are acting. Their reasons might be irrelevant or dangerous for your game. Don't follow blindly.
Generalized advice, buy this stock, is useless without knowing your specific game, your goals, your timeline.
We anchor to our own perspective. Rising prices suck everyone in. Define your game. Write it down. Ignore the noise from people playing differently.
And speaking of noise, there's the seduction of pessimism.
People love hearing the world's going to hell, even though optimism, sensible optimism, expecting progress over time despite setbacks is usually the better bet.
Pessimism sounds smarter, gets more attention. Doom-mongering gets headlines. Predicting steady growth is boring.
Why? Instinct, loss aversion feels stronger. Money news affects everyone. Pessimists often ignore adaptation, high prices spur innovation, and setbacks are fast and dramatic while progress is slow and quiet.
It's easier to build a narrative around recent bad news than slow, cumulative good news.
Pessimism grabs attention. But remember, the price of success often involves writing out those pessimistic periods. Paradoxically, expecting bad news can make good news feel even better.
Which leads to the idea of narrative power, when you'll believe anything.
When stakes are high and information is low, we become susceptible to believing almost any story that offers hope or explains chaos, like desperate patients trying medical quackery.
In finance, the stakes feel high. Getting rich, avoiding poverty. We crave explanations and predictions, even unlikely ones, if the potential payoff is huge. We want to believe certain stories.
Madoff's victims wanted to believe his impossible returns were real, despite red flags. Desire clouds judgment.
This highlights again why room for error and independence are crucial. They keep you out of desperate situations where you'll grasp at any straw.
And it all ties back to our fundamental need to make sense of things. Altogether, now we tell stories to make sense.
We constantly create narratives to explain the world, even with limited information, filling in the blanks, often confirming our biases. Hindsight makes everything seem obvious, understandable.
This leads to overconfidence, especially in forecasting. We think we understand more than we do because our story feels complete. We neglect what we don't know, the role of luck, others' hidden motives.
We crave certainty, so we demand forecasts, even knowing they're usually wrong. The illusion of control is comforting. We mistake finance, uncertainty, for physics, precision.
Risk is what's left over after you think you've thought of everything. Acknowledge the limits of your story.
So, wrapping up with the final section. Lessons and confessions, finding what works for you.
Right, the dentist story. Don't just apply generic advice without considering the individual's unique context, goals, fears. Finance isn't one size fits all.
There are universal truths, but how you apply them depends entirely on you. Decisions are made at the dinner table, not just on spreadsheets.
So the source offers summary lessons framed as personal takeaways, not rules for everyone.
Humility in success, forgiveness in failure, like risk. Less ego, more wealth, saving. Be okay with things going wrong, tails. Use money for time control, freedom. Be nicer, less flashy, respect. Save just to save options. Pay the price of success, fees, not fines. Worship room for error, survival. Avoid extremes, you'll change. Like risk, hate, ruin, survival. Define your game. Respect the mess. No single right answer.
And then shares personal examples. Saving for independence, not luxury. Owning house outright for peace of mind, not max leverage. High cash percentage for flexibility survival. Simple index funds for high probability of meeting their goals without extra risk.
Explicitly saying, this works for me. Not necessarily for you. Find your own reasonable path.
Exactly. It's about self-awareness, understanding these psychological forces, and building a strategy that fits your personality, your goals, and lets you sleep at night.
What a fantastic exploration. It really shifts the focus from complex math to understanding ourselves and our behavior.
Which, it turns out, is where the real leverage often lies.
So as you reflect on all this, maybe ask yourself, how much of your own view of money is tied to past experiences that might not predict the future? What invisible wealth flexibility options, peace of mind are you building or could you build through your behavior? What does enough truly mean to you and how will you defend it? And how will you navigate that constant tension between seeking growth and ensuring you absolutely survive to see it? Lots to think about.